Hello, this is part 3A of the final third of our inflation notes. Just by way of reminder, when we're going through these notes, this is what we're talking about right now. Coming up to conclude will be that. Earlier, I split the part 1 notes, which is this whole box, into these two bits, and then this is what you should have looked at just previously. In terms of what we're going to be doing in these notes, what I want to do is two things that might appear sort of out of step, and I feel like they're a little out of step, but will come into play in terms of how we think about the definition, or how we think about explaining the costs associated with inflation. So the first thing that I want to do is to think about what the definition of money is. Think about how we define the value of money and then link that to inflation. The sense in which these two topics, the second one being interest rates, are related is that when we think about interest rates, we can think about this, as we'll see, as a price of money. And so essentially we're talking about a thing, and then we're going to talk about its price. So we'll define what we mean by interest rates, think about things that are important to the determination of interest rates, and then conclude with a sort of brief relationship between real and nominal interest rates. So, first of all, what is money? Money is any asset that's regularly used in transactions. So, we're going to emphasize the transactions role of money right now. So, we're going to be talking about things that are relatively liquid. So, liquid is meaning that that an asset like checks drawn on your checking account or cash, paper, or coins can be used in day-to-day transactions. There are other things that we might think of as money that are less well suited to conducting day-to-day transactions. So one example of this would be gold. Gold is money in a sense that it fulfills some of these roles that we identify, but maybe serves the day-to-day common person role of conducting transactions like going to the grocery store. Gold doesn't fit that bill as well as say a $20 bill does. There are some things that we can think of as being money and things that we generally think of as money that aren't. So, in particular, when we think about debit and credit cards and Venmo balance and that kind of stuff, these are money substitutes. They are mechanisms by which you can tap into your checking account balance. Typically, it's a checking account. Um, but they are not in and of themselves money. And there are things, as I said, that generally we don't think of as money, like perhaps gold, that in fact are. If you were interested, you could click on this hyperlink to kind of nerd out on definitions of money. It's entirely optional. And it's certainly something, though, that if you went on in economics and took, say, money and banking, which is Econ 335, you would spend a fair amount of time thinking about these different categories of money. For us, I want to focus, as I said, on things that are liquid, that is, assets that are readily accepted in transactions. And so coins and paper currency and checking account deposits are the items that we're thinking about in this perspective, and this will be essentially what I'm referring to throughout these notes. So why does money have value and how do we measure that? Money's value is going to come from its ability to buy stuff. So I have a very simple example. I'm probably over explaining this, but here we go. Let's suppose that you have $1 and we have a bunch of candy. I love candy, where the price of a fun-sized candy bar is 25 cents each. What can you do with your dollar? Well, obviously, applying our higher skills in mathematics, you can get 4 fun-sized candy bars with your dollar. So, in other words, the value of your dollar, or the purchasing power of your dollar. Oh, let me see if I have Yep. The purchasing power of your dollar is 4. And quite obviously as well, if the price of candy bars rises, then the value of your currency, the dollar in this case, is going to fall. So let's think about this with a little bit more bells and whistles here. We said that the value of your $1 in terms of candy bars, its real purchasing power, in other words, meaning what are the actual goods and services, in this case, goods, uh, that can be acquired with the dollar is 4 candy bars. So we can think about this as 4 candy bars per dollar. Well, that is, we can see 1 over the price of candy bars. So, in other words, as we said before, the value of this dollar is inversely related to the price. And of course, again, when prices go up, the value of holding a dollar goes down. The real purchasing power declines. So if the price of candy bars goes to 50 cents, then the value of a dollar goes down because you can now only buy 2 candy bars. In a macroeconomic context, what is the value of a dollar? Well, we don't look at it on a goods by goods basis. We say, on average, how much in the way of goods and services can a dollar buy? And in order to capture that, we return to our earlier idea of an average price level. So in this particular case, the average price level is capturing for us, of course, on average, the prices of goods and services in the macro economy. We're not going to pay attention right now, or we're not going to worry right now about whether we mean for this to be the CPI or the deflator or the PCE price index. It's just right now we're saying on average without specificity. But the upshot of this is that as the average price level rises, as there is inflation in the macroeconomy, the value of money declines. And this is bad in a pejorative sense because money performs several important functions in an economy. So if its value is declining, its usefulness is declining. We're worse off because money is going to be less successful at coordinating our economic behavior. And so, what I want to do in this context is to think about that a little bit more systematically by investigating what are the functions of money. So, if we're saying inflation deteriorates the usefulness of money, we're saying that inflation erodes the functionality of money. So, in order to think about that, let's identify what we mean by these functions of money. So, an asset like coins or dollar bills or your checking account is going to serve as money because it serves in 3 important capacities. It serves as a medium of exchange, it serves as a unit of account, and it serves as a store of value. By medium of exchange, what we mean is that money is used to buy goods and services, and this is important in the sense that having money in an economy actually then allows us to specialize in certain activities and transact in the marketplace for others. And so that specialization is going to allow economies to grow and flourish in ways that typically don't happen if economic agents have to rely on barter. So, for instance, I really like coffee, and if I didn't have if we didn't have money in an economy, I would need to find a coffee shop that whose owner wanted to hear economics lectures, or I would need to find someone who wanted to hear economics lectures who then knew someone at a coffee shop, so I could sort of maybe chain together a bunch of transactions. So, in other words, I would have to barter. What money allows us to do is to avoid what's known as the double coincidence of wants. That is, me having to find a coffee shop owner who would be willing to give me coffee in exchange for hearing me talk about what money is, for instance. That's probably a rare event, and so I wouldn't get a lot of coffee, and I wouldn't get a lot of other things too that I particularly enjoy. So the advantage of having money in a macro economy is it sort of greases the wheels that allows us to specialize in the production of certain things and buy in the marketplace other goods and services. Money also, if assets are going to be called money, then they have to serve as a unit of account. And what that means is that it is the asset itself is being used to measure economic value. So this is important because when we think about measuring value, we're talking about whether we are conveying accurate information to producers and consumers about benefits and costs. So we saw this in these applications of the rational rules of decision making. We need to look at prices, and if prices are accurately conveying something about the value of money, then that allows us to compare that internally, depending on which side of the market we're on, to our marginal benefits or our marginal costs, and make efficient decisions. But if money is not serving appropriately as a unit of account, then that functionality of money is being eroded, and that's we'll turn to that next. I kind of think about this. I When I was learning this stuff as an undergraduate, this was the one that I really struggled with, and I think for me, the way that I thought about a unit of count is as a ruler. So if we take a foot long in the US, a foot long ruler, there are 12 inches in it. Those inches are standardized. We know what an inch is, and therefore we know what a foot and a yard and a mile and so forth are. And so we'll see how the problem of inflation can mess with that metaphor in the next slide. But before that, I want to think about the third function of money, and that is that money can be stored. It serves as the asset itself serves as a store of value. So just as money makes it easier to consume today, in other words, it serves this medium of exchange role, money that can be stored where its value is preserved allows people to save and consume in the future. This will be something that we take up a little bit later under the broad topic of consumption. If we have a lot of time at the end of the semester, we'll dig into it. But the important thing here is that it's typically why we might think about gold, for instance, as serving as money, but bananas have not. So bananas, even if we could think about them being standardized in a way where they could serve as a unit of account, and we had a banana based economy where bananas were accepted as the medium of exchange, they have a poor store of value. After a week or so, there's just not a whole lot left for making transactions. And so this third role is also an important function of money. So what I want to do at this point is think about how it is that inflation undermines the productive benefit of having money in an economy. And so we can do that by thinking about each of these functions of money. And so what I have on the left-hand side will be the function of money and a brief statement of what it is again. And then on the right-hand side, how it is that that inflation can undermine the productive benefit of having money in an economy. So when we look at the medium of exchange role, money can be an effective medium of exchange if it's widely accepted. And what that's going to depend upon is that if you want to buy something, you're going to get a good or service. The seller is going to agree to make that transaction for money if and only if it's the case that they have faith that when they accept the money, they'll later be able to use it to buy stuff that they want at reasonable prices. When we have inflation, particularly very high rates of inflation, it's not at all clear that money accepted today will be able to maintain its purchasing power. And this is something in particular. There's the podcast that I'll link into into canvas that the authors have dealing with inflation is very telling in this regard when they talk about countries that are experiencing hyperinflation. Secondly, we have the unit of account. So this is the idea that money is a measuring stick. It's measuring economic value for us. Well, in order for money to serve well, an asset that we call money to serve well in this role, it needs to be relatively stable for it to be a reliable unit of account. So if we take our metaphor of a ruler, it's as if with inflation we say, oh, just kidding. Rather than a foot being 12 inches, it's only 8 or 6. So we are eroding the value, or we have variability. One year we call a foot 12 inches, another we call it 15, then we call it 8. It becomes very difficult to think about how we can reliably measure distance, in that case with a ruler, and in the same sense, with money, it becomes very difficult to think about how we're going to be satisfactorily measuring value. And then finally, as a store of value, money can be saved. Well, again, money will successfully serve this function to the extent that it can reliably hold its value over time. So let me come back here. Inflation then again is something that undermines the productive benefit of having or using money in a macro economy. Um, and this is because money, as I said, is allowing us to coordinate our economic behavior either today, so that we're avoiding, a barter system, and as well across time, so that we can save, for instance, for the future. We can engage in borrowing and lending arrangements, which we're going to turn to next. So what we're going to see in the next set of notes, the 3B notes, is the idea that because inflation undermines the productive benefit of money, it being inflation, also imposes costs on society. And those costs, again, are arising because money isn't able to perform or isn't as able to perform its functions well when inflation is present. So what I want to do with that is sort of table it for now. We'll pick it up in the 3B set of notes and turn to this consideration of interest rates. So I want to think about interest rates as being analogous to any other price in an economy, except that here we're talking about interest rates as the price of money. So just as you might, let's focus on the green here for a second. Just as you might buy a loaf of bread for say $3.50 per loaf at a grocery store, you might borrow $100 for $5.50 per 100 from a bank. And so similarly, there would be the grocery store as the seller would sell the loaf of bread to you for this particular price. The bank is kind of like the money store. There's the bank itself would be essentially lending to you or selling to you for a period of time $100, where the price that you pay is the $100, of course, returning that, as well as the price of $5.50 per 100. So interest overall is the price that you're going to pay if you're the borrower or the demander for financial capital like money, and it is the price that you're going to receive or earn if you're the supplier from that kind of transaction. The interest rate is conventionally expressed as a price per $100, which is why it's expressed as a percentage. So in this particular case, of course, the interest rate would be 5.5%. $5.50 divided by $100, and then express that as a percentage. What I want to work up towards is thinking about how interest rates are determined. How do we come up with an interest rate of 5% or 5.5%? Where does that come from? And to get at this, what I want to do is to first begin to think about this idea that the economic function of interest rates rests on the observation that receiving $100 in the future has less economic value to you than having $100 today. And so, you can think about that for yourself in your own life. When we think about this, we could say that if you have $100 today, this is going to mean that you, so say you have $100 today. That means that you derive the benefit of that $100 again today. And it doesn't matter what it is that you're doing. Indeed, you with $100 deriving benefit from that might be entirely different from me. So you might buy something, you might buy a particular good or a service, or you could just as easily just enjoy having money. So you could, let's see if I can get this. You could be like in Disney, Scrooge McDuck, where you just like having $100 today because it confers the benefits of $100 today. But if we think about this, if instead, oops, sorry, let me come back in here. If we lend them $100, of course, you don't get then the benefits of having that today, and so you should be paid for giving up that opportunity. You should be paid for foregoing the opportunity to enjoy the benefits of the $100 today. And what is that payment? That payment, of course, is the interest and the associated interest rate. Similarly, if you really, really, really want something today, suppose you want $100 worth of a good or a service today, and you don't have the $100, then you, as the borrower, should be willing to pay to get the $100 and consume today. So when we think about interest rates are telling us something about the preference that we give to consuming today for both the borrower and the lender. So interest rates tell us about, among other things, but tell us about the priority we place on having money today versus waiting, or in other words, having that same amount of money in the future. The higher is the interest rate, the higher the priority we're placing on current consumption or on consuming today. So this idea is going to tell us one of the elements that goes into the determination of interest rates. So if we think about the determination of interest rates, one of the things that's going to be an element of this is the preference for today's consumption. So we're going to see that we're going to talk about the real risk-free interest rate. And essentially, this is telling us, or giving, we can think of this as the baseline indication of preferences for today's consumption. So this is essentially what we're describing by what we've been talking about here. So, sorry. So, what I want to do is, in fact, think about how we arrive at a particular interest rate. So, if you walk into a bank and you decide to take out a car loan for 3% for over the next 3 years, where does that number come from? So, in some sense, it's given to you, but we can dial it back and think about how an interest rate gets determined between borrowers and lenders. And so there are three things that go into the determination of an interest rate. So one of these things is this idea of there being a risk-free rate. And again, we'll express this in real terms, and we'll talk about what we mean by that distinction between real and nominal interest rates by the end of this set of notes. But what is this? So again, this is this idea of how urgently you want current consumption. An additional element of what would go into the determination of an interest rate for a borrower or a lender, but I'm going to kind of think about it from the lender's perspective right now, is the risk premium. So, lending to someone, generally speaking, involves some degree of risk, and there are several categories of or several elements of the risk premium that we might consider. And so these would include the default risk, the liquidity risk, interest rate risk, and then just overall risk aversion. So what I want to do is think about these things for a hot sec, mostly because we're going to turn to them later on in subsequent chapters when we're trying to model the sources of fluctuations in the macroeconomy. We're going to argue appropriately that some of that can come from changes in the risk premium in the macroeconomy. So what do we mean by default risk? So this is just the idea that, or the chance not being repaid. Or the person receiving the loan says thank you and promptly walks away. So that's a potential problem, and built into the overall interest rate that say a lender is going to propose would be an element, would be an amount that reflects default risk. And if a borrower is being, fully introspective, he or she or they would recognize that um, their intentions can't be correctly deduced, and so it is reasonable to have that default risk built in. The second type of risk is what's known as liquidity risk. And this relates to the idea that that when you're lending, you might not know. And so if if it's me and I've lent $100 to you, for a year. It may be that in another couple of months I need those $100 and I can't get them because you have them. So that's what we mean by liquidity risk. If I need to have those funds before the expiration of the lending arrangement, that's potentially problematic. Now, if we think about this from the perspective, say, of well, if I just take me, suppose I lent you $100 and I needed to have $100. One thing I could do, presumably, is find an asset around my house that might have $100 worth of value and sell that to raise the funds in order to make the transaction that I have to make. Similarly, if we think about a bank that makes a loan, they can, if they run into a liquidity challenge, they can usually resolve that by selling some of their other loans or other kinds of assets. But liquidity risk is going to arise when disruptions in financial markets mean that there aren't sufficient buyers around. So let me back up here and write down what we mean by liquidity risk. Liquidity risk is the problem of not having liquidity when it's needed. So again, if I loaned you $100 for a year, but in a couple of months I find that I needed that $100, say, to make a car repair or something else, then that would be a cost that I was incurring. So most of the time, markets are sufficiently well functioning that in a way that that can be resolved by just selling some other asset. But where this is particularly problematic is in times of particular strain. So when there are disruptions, in financial markets, then it's harder to find harder to raise the needed liquidity without incurring escalating costs. So if there are disruptions in financial markets that mean that there aren't any buyers for the things that I have to sell, or there aren't any that are willing to pay a reasonable price, then this is what we mean by liquidity risk. The third type of risk is what's known as interest rate risk. This is also sometimes known as term risk. And what this is getting at is the idea that lending someone money for a long period of time, the longer the time period of the loan, the higher the probability that you made a bad decision. So the longer the term, length, duration, whatever word you want here, of a loan, the greater is the chance that you'll have made a mistake. When other market interest rates or inflation change in unexpected ways. So indeed, what we're going to focus on in the 3B notes is the problem of inflation turning out to be different from what was expected. And you'll see the hint of that at the end of these notes. Um, and then the fourth is what's known as risk aversion. And risk aversion just refers to lenders' willingness to take on risk, any sort of risk. And so if there is an increase in risk aversion, it means that lenders are less willing to take on risk, and there's an increase in the risk premium. So any of these things, higher default risk, liquidity risk, interest rate risk, or indeed greater risk aversion, are all things that would cause the risk premium to rise. There is something else that occurred to me that I didn't put on the notes because I was thinking about domestic borrowing and lending arrangements. But an additional risk that can go into the determination of interest rates when we're talking about international transactions is currency risk. And this would be the risk that is associated with changes in currency values in ways that are unpredicted over the duration of borrowing and lending agreement. So these are so the fact that loans can't generally, for most of us, be made in the absence of risk means that a second element of the determination of interest rates is the risk premium. And then the third aspect that we need to take into account is anticipated inflation. So why is that? Well, again, if I have $100 today, I can buy $100 worth of goods and services. When I get repaid, say in a year after lending to you, I would like to be able to buy the same amount of goods and services, at least the same amount. In fact, I would like to buy more. That's why I would be willing to lend to you. But I would like to buy at least the same amount in inflation adjusted terms. And so, in forming an interest, in forming an interest rate, I want to, or I have to take into account what I think inflation is going to be. So what I want to do is, first of all, introduce some notation by way of summary, then take a detour into how do we define the risk-free rate, and how do we not define, how do we measure the risk-free rate, and how do we measure the risk premium for those of you who are interested. And then we'll come back to what we're doing right now. So in terms of notation, the nominal interest rate we're going to denote with this lowercase I, and we have said that the elements that would go into an interest rate would include the real risk-free rate, the risk premium, and the expected rate of inflation. Now, what we do, and we see this in especially in chapter 18, is fold the risk-free rate and the risk premium together, and we'll call that the real interest rate. And so the notation for that, the sum of these two things, is the letter R. And then conventionally, the notation for inflation is not conventionally, often in macroeconomics, the notation for the rate of inflation is the symbol pi, and the E above here isn't suggesting anything like logs or anything goofy. It just means expected. So the expected rate of inflation is what we're getting at. So, as I said, we're going to come back to this. What I would like to do first is get a little nerdy, and by considering what we mean by the risk-free real interest rate, and how would we measure it? How do we know it when we see it? And then same thing for the risk premium. So this is this notion of what is the risk-free real interest rate. For those of you, especially the seniors from Olin that are in finance, you know this. But for others that might be embarking on this, you will find that identifying this risk-free rate is really a critical idea in finance and modern portfolio theory. It is a theoretical rate of return from some kind of financial investment that has zero risk. Or, in other words, it's the interest rate that a lender would expect from an absolutely risk free loan over some specified period of time. Well, of course, in real life, there is nothing that is 100% risk free. And so we need to kind of come up with something that's close. And so in this world of close, there are a couple of ways in which the risk-free rate is measured. And so conventionally, and I would suspect in most of what you do in finance, you are using what's known as the you're using what's known as the 3-month Treasury bill rate as a measure of the nominal risk-free rate, and then you subtract a measure of inflation to get, loosely speaking, a risk-free real interest rate. So what I want to do is take a little bit of a detour from the detour and define what we mean by this. So when the U.S. government when has a deficit, it means that, loosely speaking, its spending is bigger than its tax revenue, and therefore, to finance this difference, the government borrows. And who does it borrow from? It borrows from you, me, pension companies, insurance companies, corporations, the people and governments in the rest of and firms in the rest of the world. So when it borrows, the government, of course, receives funds, and in exchange issues treasury securities. They're sometimes shortened to just treasuries. And these are just, the word here would be bonds or debt obligations. And I think those are still a lot of econobabble phrases. And so it's just an IOU. It's as if, President Biden called us up and said, "Yo, I'm going to be short this quarter. I need to borrow." And so you say, "Okay, fine. I've got, $500. I'll lend to you, President Biden and the United States government, but I need to have some sort of piece of paper that shows that we made this transaction." And that piece of paper is the promise to pay. So an IOU is just a promise to pay. And so that takes the form of a stipulation. It's like a contract that says, I, the federal government, promise to pay back the amount that I borrowed plus some interest. And so that's what a bond is. That's a debt obligation and treasury securities. The U.S. government has treasury securities of different terms to maturity. And that just means how long you're borrowing for, or how long the government is borrowing for. So there are Treasury bills, and these have term to maturity less than or equal to a year. There are Treasury notes. These have term to maturity between a year and 10 years, and then Treasury bonds have terms to maturity that are greater than 10 years. And so Treasury bills are sometimes, again, called T-bills. And one common term to maturity duration of a T-bill is 3 months. And so because the US government is widely viewed as, not never say never, but widely viewed as being safe. So this is meaning will not default on its debts, its IOUs, then Treasury securities are considered to be safe assets. And the barometer then or one barometer of a risk-free rate is this US 3-month US T-bill rate. Now, in chapter 18, we're going to pivot a little bit away from that and to try to mold the idea of a risk-free rate and risk premia and monetary policy all into one kind of cohesive package. And so what we'll argue in that context is that the Fed's target for the federal funds interest rate is a measure of a nominal risk-free rate. So I don't know that I have done this formally, so let's go. The Fed is short for the Federal Reserve System. This is the country's central bank. Among other things, it conducts monetary policy. And it conducts monetary policy, as we will discuss in very gory detail, by establishing a target for an interest rate, namely the federal funds rate. Now, the name sort of sounds like it'd be something that the Fed sets, but it doesn't. The federal funds rate is an interest rate, as we'll see when we pop back to the slide, that is determined in a market. It is a very narrowly defined interest rate in the sense that the market participants are very, very large commercial banks who are borrowing and lending overnight in the amount of $1 million or more. And so so because these are very, very short-term loans overnight, there is very little risk of repayment not occurring. So we consider from the perspective of these banks, the Fed funds rate to be, so the loans themselves are safe, and we could construe the Fed funds rate as being one measure in this context of a risk-free rate. Now, the Fed, in its conduct of monetary policy, as we will see, essentially ensures that the target it establishes for the federal funds rate is the one that emerges in the marketplace. And we'll talk about how that materializes when we are in chapter 20. So for right now, it's like a whole lot of stuff kind of floating around. But what I want to do is suggest to you that once we're in chapter 18, we'll argue that a risk-free rate for purposes of that model is the Fed funds rate. Again, in finance, most of the time, when you're looking for a risk-free rate, a very common thing to look at is a short-term 3-month T-bill rate. Similarly nerdy, how do you measure risk premia? The risk premium conventionally is measured by looking at an interest rate spread. And an interest rate spread is the difference between the interest rate at which someone can borrow and the interest rate that a safe borrower faces. So the interest rate at which this one is the risky borrower, and the interest rate that a safe borrower faces. So you can follow that hyperlink if you're interested in what defines a safe borrower, and what interest rates we're actually using. And the answer is it depends. It depends on the context. There's a little bit more discussion in the textbook in chapter 18 that you could read ahead on now, or you can just wait till we're in the midst of chapter 18 as well. But generally speaking, for the reasons that we talked about previously, the US government is viewed as being a safe borrower. And so one measure of the risk premium is the interest rate that you would pay or a firm would pay less the interest rate on a similar duration US Treasury security. So, for instance, if you wanted to get a sense of how the market viewed your riskiness in car loans, you could look at the interest rate that you would pay on a 3-year car loan, for instance, compared to the interest rate on a comparable US Treasury security, and the difference would be a measure of the risk premium. Another one that you may hear about, certainly if you study finance, you will, is known as the TED spread. TED is not related to TED Talks, it's something else, and you can follow that link if you were interested in learning more. It is defined to be the difference between, again, this US, so this is the US 3-month T-bill rate, subtracted from what's known as the LIBOR. So this is the London Interbank Offer Rate, so the 3-month LIBOR. This London Interbank Offer Rate is an interest rate that large international commercial banks would charge, and the difference then again is a measure of a risk premium. And if you wanted to see the actual mechanics of how the LIBOR is constructed and when it gets released during the day and so forth, you could follow this hyperlink. This is all just kind of FYI information. The graph here on the right shows the path of the LIBOR leading up to and through the Great Recession. You can see the sharp increase, no big surprise, in risk premia that occurred as the global financial crisis was onsetting and financial markets were melting down, mostly because I couldn't resist writing TED spread from Fred. I have the TED spread for this longer duration. And again, you can see there are a couple of times where there are some upticks. Of course, not surprisingly, I suppose the most significant recent one is when it became clear that the COVID-19 situation was going to become a fairly serious global pandemic. The risk premia shot up for a period of time. Even so, when we look at the magnitude of the risk premium then, not let alone now, but then it's half as much, if not smaller, than what happened in the onset of the financial crisis. And you can play around with graphs if you want by following either of these links. What I want to do at this point is now bring this together, wrap it up, and use this as the springboard for talking about the costs of inflation. So we have our notation, and we had our observation that that these are related in that before the fact, borrowers and lenders are looking at their own preferences and risk premia and forming a valuation for the real interest rate. They are forming an expectation of what inflation is going to be, and then combine those to come up with a nominal interest rate. It may be the case that, I as a lender and you as a borrower would have different nominal interest rates that we would come together with, but the workings of the market would, our market would mean that we negotiate and we would agree to some nominal interest rate, at which point a contract is specified. And, if we're talking about me lending to you, I lend funds to you, and you give me a piece of paper that says, I promise to pay you back. So you're giving me an IOU. So I have this financial obligation, this bond, if you will, from you promising to pay me back. Now, what I want to do is, first of all, just have a quick participation question on this point, and then we'll come back with another. So the borrower and the lender agree to some nominal interest rate, and let's suppose that this lending agreement is for a year, so doop to doop to doop to doop to doop, time passes. What happens? Well, what happens is inflation is realized or known. So we have an additional variable here floating around here that gives us a realized real interest rate. And the realized real interest rate may be the same as the real interest rate that borrowers wanted to receive and lenders were willing to pay, if it is the case that people were correct in their guess about inflation, but it may not be. So let me pause for a minute for a participation question and then come back. So it may be the case that, or it is the case, that if these differ, if it is the case that the expected rate of inflation is different from the actual rate of inflation, then by definition, the real interest rate is going to be different from the realized real interest rate. And this idea is what we will get at in the 3B notes. This will be one of the costs of inflation that we talk about. For now, what I want to do is conclude with just a picture that shows nominal and realized real interest rates over the past 60 years or so. Longer than that. But anyway, so this chart is showing interest rates on 3-month Treasury bills as the measure of the nominal interest rate. And the estimated real interest rate is adjusting for the consumer price index. So the estimated real interest rate, I just couldn't edit this chart because I lifted it, copied it from this book. This is the realized real interest rate. And if we think about the vertical distance between the nominal interest rate and the realized one, by definition, that's telling us about inflation. So one of the things you can see is that this gap grew bigger in this time period. So in here, the gap is growing bigger. We have an escalation of inflation that's happening, and so much so in this latter period of the 1970s that the real interest rate was actually negative. What that is a reflection of is that the growth rate of inflation, so inflation was positive and rising faster than nominal interest rates were rising. You can also see in this picture, roughly from 1985 and forward, this idea of there being a great as we call it in macroeconomics. We like the word great, I guess. Um, the great moderation. And this is this period over which interest rates generally came down. You can see that the gap between the blue and red lines becomes a little bit, it becomes more stable. And on the whole, this is a period in which, after which, the problem of inflation that was bedeviling the economy in the 1970s and early part of the 1980s had been mitigated, not gone away, but mitigated. And then finally, in this graph, there are two other little time periods that I want to draw your attention to. In these instances, you see, unlike any place else in this diagram, the real interest rate, the realized real interest rate, being higher than the nominal interest rate, and this is a reflection of there being deflation. And the idea would be, I mean, effectively here, effectively the nominal interest rate was zero. So if you wanted to, let me go back, if you wanted to think about the realized real interest rate, it would be the nominal interest rate minus the rate of inflation. That is essentially zero. And then if we are subtracting, say, a negative number from this, like, suppose we had 0 minus -1, then we're going to get a positive number. In this case, this would be 1, and especially, so these are not accurate numbers, but especially what we can say is that the realized real interest rate is bigger than the nominal interest rate. So with that, what I want to do is conclude a video lecture that is longer than I had wanted it to be, but there we are, and transition you into the 3B notes where we talk specifically about the costs of inflation.